Welcome to my Hot Countries video conference. You can also listen as a podcast on Substack. This is Natalie Pace, and we have a lot to go over, but essentially what we're going to be talking about are how you can earn income safely and also maybe add performance and income. Because what we've been doing is using value replacement funds. Now, there are certain sectors that are concentrated in our value funds, and in the United States, a lot of those have a lot of high debt, very heavily leveraged. And you can actually go to another country and get higher credit rating as well as higher income. And one of our hot countries doubled in share price last year while also earning a really good income. So you want to know about these other countries and why we're interested in them, why we're using them as value replacement funds, and perhaps think about using that for yourself. In addition to that, we are encouraging everybody to know exactly what you own right now because high gasoline prices are highly correlated with downturn in stocks and potentially even recessions if the war goes on. If the war ends quickly, then gas prices could go down and we could actually stabilize things and not have a recession and we may at least have one day where investors are super happy. But there's a lot of ifs in that statement. And even if the markets do go back up and recover back to their all-time highs where they were in late January, it's still a great idea to know that you are properly diversified, age appropriate, and we had a lot of our hot slices double last year. So you want to get safe, protected, hot, and diversified with no paper losses. And that's why I'm encouraging you to join us at our Financial Freedom Retreat. It's online, so you have no travel or lodging expenses. And that's going to be April 24th through the 26th. It is intensive, but it is also the life math that we all should have received in high school. So it's absolutely going to be a financial foundation for a great wealth house for your money. All right, we'll get started on our hot countries in just a moment. So if you are listening back, remember that you're going to be able to have links to all of the different web pages that I'm showing you in the description on youtube.com/Natalie Pace. If you need access to this particular episode and you're having difficulty finding it, email info@nataliepace.com and we are happy to help you, by sending you a link. All right, so the first thing I wanted to show you was this page, and this is a page on the Federal Reserve Board of St. Louis. They track crude oil prices and they put in recessions. So you can see here that there's a very high correlation. The gray areas are recessions between high oil prices and recessions. Now, the interesting thing here is that we actually had high oil prices in 2022, and even though it's not showing up as a recession, this was indeed a down year. So stocks actually, the S&P 500 dropped 19.44% in 2022, and a lot of other assets dropped even further. So we saw Tesla was down 67%. A lot of the Magnificent Seven were the ones that really dropped so far, much further than the S&P 500. NASDAQ alone, the NASDAQ Composite Index, which is really rich in biotech and technology, lost 33% to the S&P 500's 19.44 in 2022. Bitcoin lost 67%. So this is all really important for you to understand is that if the war goes on and oil prices remain elevated, then that is very bad for stocks. And the reason for that is that the economy is fueled by consumption. 70% almost of the US economy is consumer spending. So when consumers can't spend because they have all their money going to the gas station, that's a real problem for other industries in the United States. So the reason I preface our hot countries with this warning, because this is actually something that's happening right now, is because your best protection isn't not investing or not investing in these other countries. I talked about it at the top of this before you guys came on. that, Peru doubled. Australia is a country that has a higher credit rating than the United States and higher income. It's not that you shouldn't necessarily do these country replacements or have your 10 hot slices. The way that you protect yourself from a downturn in stocks is by having an age appropriate amount safe. And if you see a lot of economic storms on the horizon, overweighting safe. So in our sample pie charts, we are overweighting 20% safe. So a 60-year-old is acting like an 80-year-old. An 80-year-old, maybe you don't want to act like a 100-year-old with no money in stocks at all, but you could still overweight a little bit and have your slices be smaller. The amount that you stand to lose would be a smaller percentage. So if you're 60 or overweighting 20, you have 20% that could go down, like in 2022, 20%, not 100%. 20% of your plan would have gone down 20%. That's really easy to manage that way, because if you have $1 million and you lose 20%, you now have only 800,000. If you have $1 million invested in Tesla and it loses 67%, right? Now all of a sudden you only have 330,000. So that is going to impact your entire life. And that's why you want to always keep an age appropriate amount safe. Know what's safe, because paper losses, and then also consider overweighting safe if you're worried about the war. Now, having said that, if this war ends quickly, then oil prices and gasoline prices and all that could go way back down to where it was in the $60 range. And that's something that people have gotten comfortable with. So then we could see elation on Wall Street. It doesn't mean then that, oh my goodness, now you shouldn't have overweighted safe. Instead, what you might want to do is, if you do see that happen and you do see elation on Wall Street, that's probably going to coincide with a good time to rebalance with an eye to capturing gains. So remember, we do rebalance our plan once, twice, or three times a year, and it's done at strategic moments so that we can have a capture gains mindset. This is all something I really reinforce at our online retreat. So you might want to do a refresher course if you've attended once and you're not understanding everything I'm saying. And of course, if you haven't attended, you should attend. So that's the first one, is that yes, at this point, with a war going on and oil prices a lot higher than they were, just a month ago, the longer this goes on, the more that we are at risk of a downturn in stocks and a recession. Now, let me show you another thing that I wanted to show you as well. This is debt, all sectors, debt and loans in the United States. The reason I wanted to show you this is because a lot of us are aware that there is public debt in the United States of in the range 38 trillion. What you're not aware of is that if you added up all of the corporate debt, state debt, consumer debt, it's 107 trillion. And that is why, in a nutshell, we are using value replacements, because the companies that have the most debt tend to be the ones that are in our value funds. So the United States is a AA plus rated sovereign, Australia's AAA, but we are also one of the most heavily indebted in that high credit rating. It's not the highest credit rating anymore, but it's still very high. And in that, we are of many of our cohorts, we have the most debt and leverage. So that is one of the reasons why we are using countries to replace our value funds. A, because a lot of them have a lot less debt, and B, because some of them are giving us even more income as well. So let me show you, and again, if you are, I'm not going to, send you this entire chart, but I do want you guys to be aware of the fact that I am using a great deal, and even more than this, a great deal of data points when I'm selecting the countries I'm selecting. So we still like Indonesia, Peru, Australia, and Ireland. They are still showing up for us. They tend to have lower debt to GDP. They also tend to have a decent story on GDP growth. And they may even have a productivity story as well. There are other things we look at. It's not just those things. So it still is showing up as the same four country replacements that we have been using for different reasons. And of course, they perform differently. So Indonesia has not been performing well. But if you are doing it the way we're telling you to do it, and you didn't have any Indonesia, you are dollar cost averaging. And the reason that we do that is that if it does go down in price, we're buying more at a lower price instead of buying a whole slice and saying, why did I lose so much money? So again, this system is taking the emotions out of it and it's prompting you to do something that's actually good for you because the stocks can go up or they can go down. And by the time you get the headline on it, it's going to be too late for you to act. So instead of thinking, oh, I don't like Indonesia because that's when it's been going down. Oh, I do like Peru because that's been going up. That's not the analysis that I just showed you. What I showed you is, okay, well, what is Peru's economy? Peru is heavily tied to copper prices. What's the risk that copper prices could go down? Well, Dr. Copper tends to go down first in a recession. So that's a risk, right? And what's the risk that copper prices, or what is the prognosis that could keep copper prices where they are, which is pretty high, which is really good for Peru? Well, right now we have less supply than we do demand, and that's expected to continue this year and into next year. So that bodes well for the high price of copper. However, if there's a recession, demand goes way down. So that's going to change the equation. Again, it's not don't invest in Peru. It's if you now have two slices, maybe you capture gains on that other slice that doubled and just have trim it back to one slice. Keep the money, right? So rebalancing is a big piece of our story, a big piece of our equation. Um, and also, and just so you know, again, I'm going to have a link to the Hot Countries blog. I'm going to have a link to Indonesia, why we like that country, what the risks are, is all listed in the Hot Countries blog. Why we like Ireland, which is rich in technology, biotechnology, and agribusiness. There's another thing about Ireland, which is kind of interesting. Wasn't the case in the Great Recession, but Ireland has become one of the highest GDP per capita, GDP per person, right? So one of the more wealthy countries is Ireland these days in terms of GDP per capita. And that's new. It was not that way in the Great Recession. So again, there's the story on Peru and also on Australia. So again, I'm going to just give you highlights. I wanted to make sure that everybody knew we're still leaning into the same four country replacements and why. So again, if you want to read the full details of why, I kind of gave you an overview of Peru already, of Indonesia already, of Australia already. And Ireland is one that we even just now talked about a little bit more. So you've seen the data of our hot countries. You understand a little bit of why their story is compelling, right? So are we still going to need AI and technology, which is something that's fueling Ireland's economy? Probably. Do we still need copper? At this point, yes. Is there a point where we might not need as much copper? Yes, if oil prices remain high and we hit a recession, then a lot of projects end up getting stopped, and that's going to change the game on copper and Peru pretty quickly, right? In terms of Australia, Australia also is a country that has a lot of consumer spending tied to it. It is a slower growth country like the United States. The reason that we like Australia is that it pays double the yield and it has a much lower debt to GDP. So you can see here, and this is just the IMF website, is that Australia's debt to GDP is under 50%, while the United States is over 121%. So that's what I was saying about higher. It's also got a AAA credit rating, AA plus, and it gives you more income. So That's another reason why we like our little Australia replacement fund. Indonesia, again, this is one of the fastest growing economies. And it is part of the reason why it is hasn't been in favor with investors is that the Asian story right now is out of favor with investors. But it is one of those countries that when you hear the headlines that everybody likes, oh, they like the fact that Indonesia is going to make their own electric vehicle batteries. Indonesia is the top exporter of nickel, and they decided that instead of just exporting nickel and letting other countries make EV batteries, they're going to do it themselves. So that's going to help their GDP growth and that sort of thing, right? If you wait for the headlines on, oh my gosh, Indonesia is great, they're going to be the top exporter of EV batteries, it will be too late for you to invest in it, and you're going to wish that you had done it at a lower price. Now, all of these, again, can be volatile. So Indonesia, when we're looking at this one, this is one that has not been in favor. And I'm going to talk a little bit about dollar cost averaging, right? So you can see that this one is low on the 52-week range. It's also low on the 5-year range. It's also low on the it hasn't been around that long. It's only been there since 2010, but this is still pretty low. So let's say you have a hot slice or a slice. Do you want to go and it's each slice is supposed to have $10,000 for you? I would still dollar cost average. Why is that? Because if we hit a recession, it will drag even companies or countries that have already gone way down, it drags it down further. So that's why I would be dollar cost averaging. Would I take as long as I would if I were filling up a hot slice of artificial intelligence? No. So when we talk about dollar cost averaging, a lot of times I'm saying if it's trading at its all-time high or very close to it, fill up the slice over a 2-year period. This one is one maybe I'll say over a 1-year period. So again, you can catch all of these different countries, the why each country, as well as our Hot Countries blog itself. It's at nataliepace.com/blog. You could actually do a quick find yourself and easily find this information. We can send it to you. Happy to, info@nataliepace.com, and you can access it because I always put links to the various web pages that we've mentioned in the description section on YouTube. Okay, so thank you again for joining me. Again, this is Natalie Pace, and I'm going to show you how you can catch me on social media because I do daily money things on social media. So you definitely want to make sure you're following me there. I strongly recommend that you are signed up for Substack and YouTube so that you're always notified. Email is not always delivered. Sometimes it's sent to spam, but you are more likely to make sure that you're notified of a new video conference or podcast if you actually are signed up. So let me show you how easy it is for you to do that. Just go to nataliepace.com, and what you're going to see there is you're going to see all of my social media. There's Facebook, X, LinkedIn, right there, Instagram, email. That's going to be probably our Substack. Yep. And then our YouTube channel right there. There's also TikTok, which I just joined. So you can join us at all of those or whichever one you're on. Also, if you are interested, again, I do our financial freedom retreats only 4 times a year. The next one is going to be April 24th through the 26th online. If you would like to join us, then just go to nataliepace.com and click on the retreat flyer. You're going to learn all about it's 8 to 4 Pacific, which is 11 to 7 Eastern time. You can see a lot of testimonials. You'll learn the 15 plus things that you're going to learn and much more pricing information, etc. The best price is if you come with a friend or family member because we offer half off for the second person. So again, thank you for joining me. You can reach me at info@nataliepace.com and all the social media sites I showed you about. I'm going to ask you for one last thing. Join us for our 21-day Earth Gratitude Challenge. We actually have Jane Goodall, Queen Diambi, the Dalai Lama. All of these people have given us exclusive information And you're going to get a daily challenge from each one of these people and, 18 other ones as well. It's going to be a way to just make sure that we really have the information we need to live a green, clean life that will actually help us to save a lot of money, but it also helps us to be walking the walk, right? We can be the change we wish to see, but a lot of people are are actually and I see this so much. You're picketing and you're boycotting things that you're actually voting for with your consumer dollars. So the only way to change that, to stop voting with your consumer dollars so that everything is in alignment, because you can picket all you want, as long as you buy it, they sell it. The only way that we really get the change happening is with information and different habits. And that's what the 21-day Earth Gratitude Challenge is all about. So please go to, and I'll show you how easy it is to get there. Just go to earthgratitude.org and click there. Do you love our planet? Join us for the 21-day Earth Gratitude Challenge and register there. It is totally that easy. And while you're at it, check out our Earth Gratitude film. We're so grateful to Sia for donating a song to underscore it, and Alvin Tam, who shot it. Really, anyway, we have great people in our tribe, and we are sharing some very exclusive content. So definitely go to earthgratitude.org and register and join us for our 21-day challenge during Earth Month. And that way you'll be really set. You'll be clean and green and part of the solution for Earth Day on April 22nd. Thanks again, and I'll see you very soon.
Try